All right. So I never like to punish the punctual, so we will kick it off here tonight. So good evening, everyone. I am Michelle Boyce, Vice President, Rosenzweig Financial Services. I am going to be your moderator this evening. So for our April series and our webinar, we are going to provide you with a market update. Our friends at City National Rockdale are going to be our speakers tonight. On your screen, you're going to see Mike Nelson as well as Scott Pulaski, and they are both consultants with City National Rochdale, which is a investment advisory firm that we work very closely with. So when you logged in, little housekeeping, you saw that it is being recorded. So we'll send this out to everyone that wasn't able to attend. There is a Q&A option that you're going to see in the chat bar there. If any point throughout the presentation that you have a question, please put that right into the Q&A. I will make sure that we get it to you either during that segment or at the end when we have time reserved for the Q&A. So with that, let me make the introductions for the evening. So first we have Mr. Michael Nelson, who is a certified financial analyst with City National Rockdale. He's been with them since 2017, but has over 20 years of experience in the financial services industry. He's a managing director as well as a senior investment consultant. So Mike, I just want to thank you for taking the time tonight to join us. And then also we have Mr. Scott Pulaski. So Scott has been with us, what we call CNR. We'll reference that tonight for short, since 2007. Scott is also a certified financial analyst, as well as a accredited investment fiduciary, a certified financial planner, and a certified private wealth advisor. All of those acronyms at the end of his name make his business card very long. But they both bring extreme experience with us tonight to this webinar to be able to provide you with this market update. So we're just going to run through the agenda quick for this evening. So we're going to do a brief introduction on who CNR is. Then we're going to dive into the economic outlook and investment strategy based off what the outlook is, and then talk about some active tax management. So with that, I'm going to hand it over to Scott as he gives the introduction on CNR.
Hi, everybody. Hope everyone's doing all right this evening. Thank you guys again for having us, Team RFS. My name is Scott Pulaski. I've been with CNR, like you said, for 16 years. If you haven't heard of us before, we are a fully owned and private investment management company that partners with independent advisors to build custom portfolios and manage assets. While most of you probably haven't heard of City National Rockdale, I think almost everybody's heard of Royal Bank of Canada. So Royal Bank of Canada owns City National Bank, who in turn owns who owns Rockdale. So we're a little boutique operation inside of the 6th largest bank in North America. We've got about 320 employees spread around the country. Main offices, New York and Los Angeles, a couple smaller offices, San Francisco, Chicago, Houston, and my office in Lake Mary, Florida. Our office, we manage about $62 billion. And with that, each and every portfolio we have is handcrafted. If you could give me the next page. The firm's been around over 30 years and partnering with advisors. And the way I like to think of it is that your financial advisory team, Michelle, Mickey, and the team at RFS, is sort of your architect of your financial world. And their job is to put your financial world in order with a whole host of different services. On the investment management side of things, you have City National Rockdale. And we are, and it's strictly the investment manager. We're the contractor that puts the nails and screws to work, put your money to work for you. We predominantly work with individual stocks and bonds. Everything we do is custom craft and bespoke. And in order to do that, you need to have a lot of really highly qualified folks pulling the triggers there. There's no models at City National Rockdale. It all starts with a blank sheet of paper and a conversation with either someone like Scott, like me or Mike, and then moves on to our portfolio management team, where we craft portfolios using a combination of what we know about you and your goals and what's going on in the economic and financial landscape. And the portfolio management team, you have ongoing communication on a regular basis. They're looking at your accounts every day and keeping you guys abreast of what's happening out there. Mike Nelson, my colleague here, has been so gracious in his to do the economic side of things today. Mike actually worked on that side of the business before he came over to CNR on our side of the business. So it's going to be a little bit of a old hat for him, but he's going to fill you in because we adjust all of our portfolios at City National Rockdale based on what's going on the economic and financial landscape. And there's going to be times where things look good, times where things look not so good, different areas of the market that are going to react differently to different conditions out there. And rather than having a portfolio that's kind of set it and forget it, these portfolios are going to adjust to what's going on. So we're going to fill you in a little on what's going on out there in the world and then how we're adjusting portfolios. And as a caveat to that, being that everything we do is so customized and personalized, the last section of this, we'll talk a little bit about how having a private, individually managed portfolio can generate some real alpha and tax savings in the portfolios as well, which is sometimes often forgot. So with that, I'm going to let Mike do the heavy lifting today. So Mike, I'll let you take it away.
Well, Michelle, Scott, thank you so much. Pleasure to be here. So thanks for everyone that's joining us this evening, taking some time out of your regular evening plans. I know I got, my kids, they're busy with stuff. I said, give me a break, guys. Dad needs half an hour to join with some colleagues here to do a meeting tonight. So very happy to be here. And again, appreciate all of your time. So we're going to spend maybe the next 20 minutes or so walking through what Scott just laid out, City National Rockdale's economic outlook, and talk about some of those investment strategy implications. Generally speaking, how we're thinking about incorporating our insights into clients' portfolios. Obviously, to Scott's point and Michelle's point, not one size fits all. When we're ultimately executing in client portfolios, everything is very much personalized to unique goals and objectives. But we thought we'd take it back up to that higher level tonight and talk about what's playing out in the markets right now, what's important, what's making noise out there that maybe isn't as important affecting markets. But obviously all these pieces, all these components are things that we're looking at on a regular basis and thinking about what makes sense to incorporate in client portfolios. So that, let's go ahead and jump into the content here. So a lot of bullet points, lots of words. I'm just going to summarize this high level, starting with the economic outlook on the left-hand side. Now, this comes from our investment strategy committee. These are our folks, our heads of economic research, our folks that are the heads of stock market and bond market research, our in-house economists. And what do we think are those driving economic themes behind the markets right now that are having impacts on ultimately asset classes or segments of the markets, and then ultimately client portfolios? So starting at a high level here, increased confidence in the outlook for a soft landing. I'm sure many of you have heard that term thrown around in the headlines. That's going to be the ability of the central bank here in the US to not drive the economy into a recession, but rather slow growth down. Hopefully we're going to be able to bring inflation down here and control those two components together so that we navigate what's known as a soft landing, again, without tipping the economy over into major layoffs, job losses, and ultimately bear markets for the economy, for stock markets and other risk assets. Now, with all that said, inflation, we still continue to hear this elevated. And that's obviously something that is impacting the way all of us feel day in and day out. It's on voters' minds right now as we head into the election. We'll talk about that a little bit later. But inflation is one of those big key points out there that we're talking a lot about and we're focusing a lot about. And we've got some slides that will touch upon that later. Now, we do expect that the Fed will lower interest rates this year. Now, you can see that we say here 2 to 3 times, beginning around mid-year. If we went back to the beginning of the year, call it January 1st of 2024, and we looked at market expectations for the central bank to be cutting interest rates, the market was pricing in about 7 interest rate cuts. We thought that was pretty aggressive, right? All those interest rate cuts, that's very positive for stock markets. I think that's the reason why the stock markets have done what they've done since the beginning of the year. And now that we're all coming to grips with what reality is, and more along the lines of what Rockdale was thinking about, we're going to see probably fewer rate cuts this year and probably not starting until the middle or perhaps even the latter part of this year, which is why the stock market has been doing what it's been doing for the last couple of weeks. And we've seen those stock prices selling off a bit, kind of adjusting to those expectations. Now, all that said, the consumer still feeling very, very strong. Here in the United States, what the consumer does, how they feel and how they spend drives 70% of our economic growth. GDP, gross domestic product, right? So when we see the consumer still feels good about things and they're still spending and their real income, right, what their earnings are adjusting for inflation. When we see that being a positive backdrop, that's why we still feel relatively good about the markets. That's why we think that we'll be able to navigate one of these soft landings that the Fed is talking about. But we do see that there's some stresses out there. People are starting to see it when they're going grocery shopping, higher rates for mortgages or any lending that they're doing. And that's probably going to start to dampen consumer sentiment a little bit, perhaps slow down spending. But we certainly don't see it causing something that's going to have us, again, tip over into an ultimate recession. Okay, the U.S. economic outlook, more resilient than European and Asian economies. We obviously focus on economies all around the world, both developed as well as the emerging landscape. We still think that the U.S. economy is the best house on the block, so to speak, as far as the ultimate driver of economic growth. So when you see our investment tilts that we're making in client portfolios, it's largely, at the current time at least, going to be more domestically focused. Elections, everyone's talking about that. They contend, are usually contentious. There's a lot of volatility leading up to ultimately the election. Headlines obviously drive a lot of that. We're a very bifurcated, voter populace here, but we tend to sort of look through that volatility. And I got some slides later. They're going to talk about how the market reacts during election years, and also how it reacts or performs during different mixes across the president's, the Congress, those types of seats. Geopolitical risks at the bottom here. This is probably one of the largest areas where we do see those risks right now on the horizon. It's rising escalations, whether it's the Russia-Ukraine situation, whether it's in the Middle East or it's over in China. We see those potential events there as being really the spots that we're looking as where we could see, again, that escalating conflict maybe start to bleed through into the broader global economy. But again, it's one of those things that ultimately at the end of the day, it's very important and it does drive near-term market volatility. But those underlying fundamentals of the US economy are really what's key to the outlook over here over the near to intermediate term. So investment strategy on the right-hand side of the page, we are expecting more modest returns across asset classes in 2024. Our firm has had more of a focus on high quality stocks and bonds over the last handful of years, as we've been focusing on some of these more volatility causing events, higher interest rates, a central bank that's looking to slow the economy down. Again, these tensions overseas. These are our types of investment decisions that have helped our clients weather some of the volatility that we've been experiencing more recently. I kind of mentioned staying focused on the US for certain reasons. Obviously, when we're thinking about investing our clients' portfolios, we want to make sure that what they're experiencing as far as the ups and the downs in their portfolios are something that they can handle. And when we look at the US economy, US equities, other asset classes here in the US, we see that we've got a better volatility profile as far as the ups and downs of those markets go, and also delivering what we think will be the better returns to the marketplace over the foreseeable future. Okay, I kind of mentioned this year, we're continuing to avoid international equities. Obviously, that's something that may change. Doesn't mean that City National Rockdale is always going to be focused only on domestic equities. We don't have a particular style or mandate that we're beholden to. We do manage customized portfolios for clients, Scott mentioned. But again, when you look across our client portfolios, we see the best opportunities right now focusing on the US. Okay, focusing on quality. Right, looking to extend duration and looking across not just stocks, but also bonds. For the first time in many, many years over the last handful of months here, we're seeing ample opportunities to invest in investment grade bonds and find attractive coupon rates of return, interest payments for investors, obviously thinking about the tax implications that has and thinking about the way to implement those ideas in client portfolios. But we see great opportunities out there right now, not only in the stock market, as I mentioned, but across bonds as well. And we'll talk about investment grade bonds as well as high yield bonds coming up shortly. And lastly here, alternative investments for particular client portfolios. We don't have a one size fits all asset allocation for clients. Alternative investments can be used to solve many different problems or address certain circumstances in client portfolios, but we think about the right opportunities to include different types of alternative investments in client portfolios where it can ultimately help meet those specific goals and objectives that we're seeking to dial into with our personalized portfolio management.
Hey, Mike, could
Okay.
you give an example of what would be an alternative investment that might be in favor now, currently?
Yeah, so right now, when we broadly think about alternative investments, we're seeing opportunities in the extended credit markets, be that direct lending, uh, floating rate fixed income, high yield bonds, moving into that sector of the credit markets are where we're seeing opportunities right now to move beyond your traditional stocks and bonds. Now, we can extend that a little bit further though to talk about clients to say, well, what are you really seeking to achieve? And if it's for investors that are looking to bring something into the portfolio, it may have less sensitivity to stock market volatility, to bond markets or interest rate fluctuations. We can think about alternative asset classes that are exposed to things like natural disasters. So reinsurance, the big insurance companies that insure the insurance companies. We collect the premium, and what's your risk there? It's hurricanes hitting Florida or the Gulf Coast, right? But we're looking at an attractive 8 to 9% rate of return off those type of investments with zero correlation to stock and bond markets. So again, we take this allocation to alternatives on a case-by-case basis and think about the role that it plays in each client portfolio uniquely.
Thank you.
All right. So let's get into some of the statistics here now. Hopefully some of you have seen our economic speedometers before. This is a piece that we publish on a monthly basis. It comes down to all those 50 research individuals across the firm talking on a regular basis, interpreting the quantitative data, labor market, right? Unemployment claims, employment numbers, looking at the housing market. I talked earlier about consumer sentiment and consumer spending. A lot of this stuff you can measure quantitatively, but then there's also things we talked about down here, like the political environment here at home or that geopolitical environment around the world. What does that mean more qualitatively and the impacts that that might have on the markets? So rest assured that we're thinking about everything holistically and not equally weighting each of these speedometers that we see here, but again, understanding the impact that that has on markets. And you can see here that we say that these are forward-looking 6 to 9 months. Now, just to kind of give you an idea of how to interpret this, if you see a green speedometer, like the labor market right now, that's green. That's positive for markets over the next 6 to 9 months. Yellow, that's intermediate, neutral. So neither good nor negative nor positive, but just neutral right now. And when you see a couple of these red speedometers, the negative speedometers, well, that means that stock markets right now possibly overvalued. Now, this goes back to the beginning of April. We've had a pretty substantial sell-off here in the equity markets over the last couple of weeks, which is starting to make other pockets of the equity markets look more attractive. So we're being very thoughtful in how we're deploying or redeploying capital within client portfolios and finding those opportunities to take advantage of particular stocks, particular sectors. What we had Facebook, Meta, whatever you want to call it, sell off 11, 12% today. Maybe an opportunity for clients that were underweight in that particular position in client portfolios to add a little bit more. So we're very opportunistic in how we take a look at what's playing out around the world and seek to take advantage of those opportunities as opposed to just applying kind of a broad general market view to all client portfolios equally. Now, one last thing I want to point out to interpret how we see this here. Let's talk about corporate profit growth. I'll just come to the middle of the page here. Hopefully you can see the lighter gray shaded needle there in the middle of that speedometer. So last month, April of 2024, we were in that yellow or neutral zone for corporate profit growth. Based on the latest data that we've seen, that's been trending in a positive direction and has slightly moved into the green. So these speedometers are a nice way for not only clients to get a good idea for how we're feeling about the markets overall, but the general direction that we're trending in when it comes to these speedometers. And for those of you that are so inclined, you can always visit our website, www.cnr, like citynationalrockdale.com, and you can go right to our economic insights, find our speedometers, and it gives you some nice talking points, as you can see on the left-hand side of the page. It gives you a pretty good idea about how we're feeling about the markets overall over the near to intermediate term.
So,
Okay.
Mike, there's a question that came in that's going to test your memory a little bit. So we're not going to hold you completely. But if this was April of 2023, all right, so a year ago, were these speedometers kind of looking in the same way, or did we have red other places that now we have green?
There was
They
no
were
green.
pretty much all yellow, and about the two red ones that you see there were red. Yeah. we were in quite a different environment going back about a year or so. Again, we were still kind of reeling from the interest rate hikes from the central bank here, very large sell-offs in both stocks and bonds during 2022. The consumer households weren't feeling too good about things. So we were much more in that neutral zone, not a whole lot of negatives, but much more sitting in that neutral zone. So over the last 12 months or so, we have started to see that fundamental economic backdrop starting to become more supportive. That doesn't mean that we're not going to see bouts of volatility like we see in the equity markets here from time to time. But again, over the next 6 to 9 months, over the next few years or so, we certainly see that fundamental economic backdrop starting to become more supportive of what we call risk assets, or generally speaking, stocks and high yield bonds, to simplify things. All right. So moving on here, risks to the economic outlook diminishing. I already touched upon this, so I'm not going to spend a whole lot of time here, but this kind of presents our base case right now. Now we're starting to think that I mentioned that it says 60% here, but we're now of that view that there's about a 70% chance that we're going to enter more of a soft landing, which is good for the economy. It's obviously going to be something that we're watching, and the risks to a mild recession, it's still on our radar screen, so to speak, but we've been reducing that risk. That now stands at about 30% that we might enter a mild recession. Not to be confused with something like a COVID type recessionary environment or a global financial crisis, but where growth might moderate, dip into negative growth ever so slightly. Something that's on the radar screen, but certainly not in our base case. I've already touched upon the outlook for 2024. I'm going to very quickly just kind of highlight some of the things that we're talking about on this page here. I think the left-hand bullet points give you a pretty good idea about how we feel about things. Growth expected to moderate. We've been growing at a very, very fast pace with this economy here until just recently, right? So our GDP quote for the first quarter of 2024 has slowed down considerably over the last couple of years. So we're starting to see that impact that higher interest rates that the central bank has navigated starting to have an impact on consumer spending, but it's nothing that we're seeing that's going to tip those speedometers into a red zone, so to speak. We talked earlier, 2 to 3 rate cuts, possibly beginning around mid-year, probably more towards the latter half of this year. That should obviously be very positive or supportive for the markets when we do see the Fed start to cut rates. But again, we thought that the market got ahead of the Fed's expectations for multiple rate cuts this year, beginning as early as March. And that's why we're seeing this volatility in the stock market here more recently as a result of less expectations for interest rate decreases. And that's what we're seeing weighing on stock pricing right now. Let's jump ahead. I talked about the election. Obviously, these make a lot of headlines during years such as this. And this is pretty interesting to take a look here at the top chart. S&P 500, so our 500 largest companies here in the US over election cycles. Let's take a look at the average and the median performance during an election year, right? On average, since 1928, it's positive. So certain of us feel one way, certain of us feel the other way about how an election might impact the markets. History has told us that we still typically see positive performance on average for US stocks, given nearly 100 years worth of history. And extend that out 1 year, 2 years after the election, when we get into midterms, that always causes a lot of volatility, a lot of headlines as well too. We still, on average, see positive performance for US stocks during these points of election years of voting cycles. And you look at this 3 years out, so we're kind of now averaging things out over a longer term horizon. We do see that the impacts of election years really do have very little to do with stock market performance over even the short term to more of the longer term. Now, on the bottom part, this is always a neat chart to look at. This is the composition across the president, the Senate, and the House. And we look at, again, nearly 80 years worth of data here. What's the average performance of the S&P 500 been with these different mixes? Democrat, Democrat, Democrat for president, Senate, and House. Positive performance. We can mix it up. Any of the nomenclature, the acronyms you want to use here, DDR, RRR, you can see it across the page here. We typically see positive performance. So obviously the markets like gridlock. We got to mix across different parties because then not a whole lot changes. Markets love when things don't change a lot. But we've got this one standout here to the far right-hand side where we had the Republican president, Senate, Democrat, House, again, mixed. Typically the markets would like that, but we had a pretty substantial sell-off during that type of period. But again, that's very heavily influenced by the 2001 recession following the 9/11 attacks. So certainly something we're happy to talk about. We're not ignoring this, but we like clients to understand that we need to kind of, look through this volatility that the headlines can cause here, and let's focus on market fundamentals, and let's focus on the bigger picture, perhaps some of those geopolitical risks I talked about earlier. Now, this is a neat chart too. I'm going to talk about the right-hand side very quickly here and then look at the left-hand side. But really, you can look at almost every single calendar year and find some reason that if I told you at the beginning of the year that a particular event was going to happen during that calendar year, you would say, I don't want to be invested in the markets right now. We're talking about geopolitical situations here on the right-hand side, and you can see, a couple of dozen of them right here, and what the economic impact or the market impact has been as a result of that. Now, what we're showing on the left-hand side is putting those numbers into bar chart form, right? Taking into consideration the average 1 week, 1 month, 3 months, and a year after these different geopolitical events. What has the performance of, again, U.S. equities been? And as you can see, generally speaking, we see very positive outcomes, maybe some modest declines, but this is when those geopolitical events have caused a recession. And when those geopolitical events have caused a recession, what's the average return been versus when those geopolitical events have not caused a recession in the US? So you can see that we're obviously watching these events unfold. Right now, we don't think that a lot of these geopolitical events would have a major impact here on the US economy, but something that we're always very sensitive to. And we love to keep all of you, our investors, our clients, our informed about what the outlook is for these types of events. But at this point right now, our base case is it's not going to trickle over into having any major impact on the US economy. So let's go ahead and jump ahead here quickly. Inflation's been a big headline that everyone's talking about. We do see that inflation, as you can see on the right-hand side here, has been declining from the highs that it reached back in 2022. Thank goodness. Right? But most of us as consumers, we're still looking at the prices, whether it's fuel, whether it's housing, whether it's what we're paying for in the grocery store. We still see that it's quite high, relevant to what it was going back just a couple of years ago. But that year over year increase is something that has moderated quite a bit, but we haven't reached the Fed's level of 2% inflation yet. What you can see here, though, is this light gray shaded bar within the stack of bars. The majority of that is still shelter. It's housing, right? Many folks, they've got low interest rates on their houses right now. They're not looking to move. They're going to stay where they are, maybe make some home improvements, but they're not looking to refinance or get a new mortgage or move right now. So the supply of housing in the marketplace is very, very low. So that's why we're seeing increased upward pressure on housing prices, on rents as well, too. The story is consistent across, rental housing as well as for sale housing. And that's really where the hot spot is as far as inflation is concerned in the market right now, at least as far as year over year increases go. That's where we're still seeing quite a bit of pressure on inflation. Jumping ahead, I talked about this earlier, those expectations for interest rates. Our central bank here in the US uses interest rates. That's their number one monetary tool that they can use to slow inflation down, perhaps try to slow growth down, perhaps prop up labor markets, wherever the case might be. And you take a look at the green line here. This is showing us back in December of 2023 what the market thought the central bank was going to do with that Fed funds rate. Right, so the rate that they're charging banks to lend back and forth to one another, central banks, that's called the Fed funds rate. It ultimately lends itself to more shorter term, longer term interest rates, all the way out to what we're paying on our credit cards and mortgages. But it kind of really sort of drives the path of interest rates. And you can see that expectations were that the central bank was going to very quickly over the next year or so reduce interest rates. That changed a lot by the time we got to February of 2024. You can see that here. Now, this light blue shaded line here, that was City National Rockdale's forecast that we were going to remain higher for longer, perhaps see some interest rate cuts coming the latter half of 2024. we're still sticking with that base case. But this is, again, one of the reasons why we've seen some of the correction in the equity markets here over the last couple of weeks, last couple of months, as the market's coming to terms with higher for longer interest rates. I talked about how we do prefer the US relative to other markets around the world. We apply our own proprietary framework in assessing where we want to be invested around the world. We call it our 4Ps framework. It's looking at demographics, productivity, population growth, things of that nature. And this is kind of like a score in golf. The lower the score, the better. When you rank number 1 or number 2 in a category, your score is going to be lower than someone that's the 30th or the 40th worst marketplace to be out there. So when you see the US with the lowest score relative to developed markets around the world, and even relative to emerging markets, this is why we still have that more of a kind of a tendency in our client portfolios towards domestic asset classes. And if we look at performance, right, 2023, year-to-date 2024, and even looking back over 5 years, you can see that the darker blue shaded line here, the S&P 500, has largely outperformed developed international markets and emerging markets over all of those measurable time periods. So that's a position that we've taken in our client portfolios. It's played out pretty well over the last decade, 5 to 10 years. All right, quickly moving on. We've heard the Mag 7. That's a term that's been thrown around a lot. You can see those magnificent 7 stocks here on the right-hand side of the page that make up nearly 29% of the S&P 500 stocks here in the US, and 7 of these names made up 29% of that. And that's really been what's driven stock market performance over the last couple of years. Okay, we're starting to see that even out a little bit. We're seeing more broad leadership across different sectors, some more of these dividend paying stocks, some of the more steady eddy value stocks out there. That's something that we're very happy to be seeing. We don't think that we're going to continue to see this very narrow swath of names driving stock market performance over the near term here. But this is kind of interesting when you look at the left-hand side of the page here. 26.3% rate of return for the S&P 500 over this time period. Let me just move our faces here as I do this, just to make sure you can all see this. That's the S&P 500, 2023 and year to date. Again, largely represented by these 7 stocks. If you remove those 7 stocks, it's quite interesting to see that the S&P 500 minus those tech titans, only about a 10% rate of return in 2023, 6.7% year to date. Quite a dramatic difference. Now, if you want to take that more prudent approach and equally weight all of the names in the S&P 500, so now we're equally weighted to all those other 493 stocks that are in here right now, we can see much more modest rates of return. Again, this is more of what we're thinking about going forward. We're going to start to see some more breadth as far as leadership goes across performance in the US. And that not only applies to large cap stocks, but also to small and mid cap stocks. So if we do start to see the central bank navigate this soft landing here, we're going to start to see that leadership as far as opportunities for stock market performance start to lend itself to both mid cap and small cap stocks. So those are areas of opportunity that we're looking forward to begin implementing in client portfolios.
So Mike, a quick question on that.
Yes.
You just talked about, the Magnificent 7 there, and it's those returns are kind of very eye-opening, right? The comparison. Has there been another period of time that has a similar, top 5 or 10 companies that were really moving the market the way that it is today?
Yeah, I would have to go back to right after the CARES Act was passed. So we had COVID obviously come on the scene in March. We'll call it March 1st of 2020. All of a sudden, COVID became a real thing, and the market sold off 30% over 3 weeks. And then our central bank, the government, monetary stimulus, fiscal stimulus started injecting all this liquidity into the system. And back then they were calling it the FANG stocks, right? Facebook, Apple, Amazon, Netflix, Google, right? That's what it was back then. And we saw those 5 names, again, draw the entire equity markets up double digits for the year. And that was even during an environment where more and more people were dying every day. There were no vaccines. Everybody was staying at home and not working. So it's interesting to see the impact that some of these high beta or kind of ultra high growthy technology stocks can have in markets in very pronounced periods of time, which is why we believe that over the longer term, it's more prudent to be diversified across multiple sectors across US equity markets. Again, not just large cap stocks, but small caps and mid caps as well. And I'm sure I don't have to remind everybody about what happened back during the tech bubble burst as well, too, where we saw technology stocks, at least these technology stocks that we're talking about now, have growth in earnings, right? Back during the tech bubble, we were talking about .com stocks that had negative earnings and they were going to the moon. So, we see trends, we understand when they're happening. It's not that we want to miss out on them, but we also want to make sure that, we don't have a 7% position in NVIDIA in our portfolio. We're pretty comfortable owning 2.5% in client portfolios. And obviously we'll look for opportunities to take advantage in sell-offs or opportunities where, we might want to pare back on those names as we see prudent in client portfolios. Okay. It's been a couple of rough years. I'm not going to spend a lot of time on this page, and I know we want to wrap things up here in a few minutes for you folks. But if you look across the last couple of years, no matter what asset classes you've been invested in, stocks, equal weighted S&P 500, like we talked about, technology stocks, the Dow Jones, investment grade bonds, high yield bonds, you can see that we've pretty much arrived at the same place over these years here, with a lot of volatility in the interim. So it's been a couple of rough years for investors. We saw obviously 2022 punish both stock and bond investors. 2023 was a better year for investors, and 2024, largely speaking, off to a pretty decent start. But we're thinking, again, we're starting to see that fundamental backdrop, those speedometers going from what was largely yellow during this entire time period here, starting to tick back into the green. So we're going to start to see those opportunities for stocks. And we like the coupon yield, the very attractive rates of return that we're getting from interest payments off these parts of the bond markets, contributing quite nicely to balanced client portfolios. Volatility is normal. This is the stock market. S&P 500 across this, close to, as long as I've been around, obviously, right, about 45 years here. So 75% of the time, we see that stock market performance is positive. 25% it's down, but take a look at those red dots. In every given year, this goes back to those geopolitical events. I could tell you something that's going to happen during the year that's going to really draw from the peak to the trough down very substantial negative returns within equity markets. So we need to understand that volatility is normal. We want to make sure that our clients understand that. And we're always here to speak with clients, as Scott mentioned earlier, getting together on a regular basis to talk about what's happening in client portfolios. And we're going to think about when we do need to make those changes or those adjustments in client portfolios when these negative returns do seem like they might be spelling out something that's going to be more of a pronounced bear market environment. Okay, I'm going to just jump ahead here and kind of wrap this up to our 2024 key asset class expectations. Just to summarize everything we talked about here tonight, U.S. equities, we believe, should outperform non-U.S. equities. So that's, again, where you're going to see our stock side of clients' portfolios allocated right now. We do have a handful of international stocks in client portfolios, but they're household name brands you'd recognize here in the US, like Anheuser-Busch or InBev, right? They're conducting their sales all across the globe. So we're not only US focused, we are finding those opportunities around the world to incorporate some of those developed market stocks in client portfolios, but we're being very selective, right? History suggests that after all these years where those growth stocks, those high growth stocks that have really driven the market, the Mag 7, the FANG stocks, we're going to start to see that some of these more dividend-oriented or value-oriented stocks are starting to show their stripes again and contribute to positive performance for stocks overall. We certainly like that backdrop when it comes to managing balanced portfolios for clients. Fixed income returns, we expect that to be mostly positive. Certainly, we're going to have some near-term interest rate volatility here. But again, the Fed's forecast is to reduce interest rates at some point later this year. We're appreciating right now the higher interest payments that we're getting, whether it's in municipal bond portfolios for taxable clients or in corporate bonds. We certainly like the income stream that we're seeing right now. And should interest rates start to tick down towards the second half of the year, well, that's obviously going to be attractive for appreciation of those bonds as well. Lastly, alternative investments, one of those things that we take kind of case by case and think about the attributes, the positive benefits that may contribute to client portfolios and seek to find those opportunities where they're attractive. And again, kind of what I'll call more of an opportunistic basis and incorporate that into client portfolios as well. Lastly, just for the last maybe 1 minute of our prepared remarks here, we talked about active tax management, which when you work with a manager like Rockdale, not only looking things big picture overall with respect to the markets and making changes in client portfolios to avoid the risks that we see out there, take advantages of the opportunities that we do see, we want to think about the tax implications. So we're not going to blindly just apply a trade to add to a stock or reduce exposure to a sector across all client portfolios equally, especially the client's taxable accounts. We're going to think about where we can harvest losses in client portfolios, be very smart about the way we implement those ideas in client portfolios, and it can add 1 to 1.1% to a taxable account in a given year. Now, that may not seem like a lot, but on a $1 million taxable account, if you look at over 20 years, that's about $800,000 to $850,000 of tax savings over that time period, over call it 15 to 20 years. So very meaningful. Some of those, more, maybe not quite so visible components of total return for clients, but when you look at it on a client by client basis, it's about what you keep, not just about what you make. One of those areas where we can unlock some value for clients. And that's one of those things we're thinking about on a daily basis, not just what's playing out in the markets. Okay, so with that, I'll just maybe turn it back to Michelle to see if there's any final questions that we have here. And then thank everyone before I stop talking for joining us tonight. I appreciate everyone dialing in here. Hopefully you found this useful. Reach out to RFS. Any of us, we're happy to address any questions, concerns you might have, and look forward to engaging with you more in the future.
Thank you, Mike. Very informative. Scott, while we wait for questions come in, so if anyone has an additional question they haven't asked yet, please use the Q&A now. Scott, anything that you would like to touch on and elaborate on as well?
Yeah, just going back to Mike's thing, it's about asset placement sometimes too in that tax alpha. It's knowing where to put the right types of investments. A lot of investment companies, they stick a little bit of everything in every type of account. But when you're looking at a portfolio for your average person, probably on the call today, they have some qualified money, they have some taxable money, and it's important to place things that generate ordinary income into the IRA accounts and things that can generate, like dividend stocks, a preferred dividend rate or a lower tax rate in the taxable accounts. It might make your accounts look a little bit wonky from a performance perspective, but it's going to net you more dollars in your pocket, which is really what drives every decision you should be making when you partner with an advisor. The other thing I'd put out there is if you like what we had to say today, Mike clearly knows his stuff inside and out. If you want us to review your portfolio and just make sure you're placed properly for what's to come on the horizon here, we'd love to take a look and do kind of an MRI for you. It's a complimentary part of everything we do. And the only obligation that maybe we spend a half hour talking to you about what you've got that's good, what you've got that needs a little help, and just making sure that you're on the right track for your goals. And as part of our longstanding relationship with RFS, we're happy to do that at no cost for you guys.
Perfect, thank you. So no question, just some comments of great content, very informative. A lot of information, right? But I think there's the key words, right? The buzzwords that we all hear, right? What's inflation doing? Like Mike, you said, that impact we're feeling. I feel most of us probably feel it at the grocery store. Every time I buy grapes, they're more and more expensive. I'm like, why are grapes so expensive? No. And the housing, especially here where Mickey and I are in South Florida, the housing inflation rate is extremely high, but also like that interest rate environment. How long is it going to last? So I think getting a peel back of how all of this then has that rippling effect into someone's portfolio of how it's being invested is great knowledge to be able to pass on to everyone. So with that, we thank you for your time and your expertise and knowledge, and thank you for everyone attending and then everyone who's listening afterwards. So we will wrap for April webinar. We will see you in May and next month, our webinar then. So have a great evening, everyone.
Thank you.
Thanks, everyone.